In this session, we'll try to understand about structured credit risk. Now, what do we mean by this? We are primarily talking about the credit risk that is present with respect to structured products. What are these structured products? They are almost the new innovations today in the financial industry. Any product whose cash flows are based on credit linked assets, like whose cash flows are based either on loans, whose cash flows are based on any other credit based claims, like credit card receivables or vehicle loans or any such kind of credit related assets. If the cash flows are based on either loans or any other credit claim, we are calling those kind of products as structured products. And we all know the structured products have come up because of the concept of securitization, where we see the banks or any lenders, they are selling off their credit linked assets like loans, different kinds of loans, or credit card receivables, or even account receivables. Any of these credit linked assets, they are being sold off to a third party, who in turn is creating bond kind of securities and issuing them to the public investors. So these kind of products that are getting created are getting classified as structured products. Now, our intention is to understand what is the credit risk that is involved with these kind of products. So, to start with, we need to understand what are the various types of structured products that are available in the market today. Right? Then we can try to look at how we try to address the credit risk in each one of them. So to start with, we are talking about the covered bonds. Right now, as one of the structured product, I am looking at the covered bonds. Typically, they are called as on balance sheet securitization instruments. Why so? It's not an off balance sheet. This is one thing we need to be understanding. When I say on balance sheet, all we are doing is, okay, let's say a bond has been issued. A bond has been issued, and against this bond, to secure this bond, a a set of mortgages is segregated from other loans, is separated from other loans on the balance sheet. So on the balance sheet, we see one asset called loans, the other asset which is a pool of mortgages, which is a cover for this bond. So on the balance sheet, the mortgages still exist, and this against this pool of mortgages is this bond typically being issued, and it lies on the balance sheet. And of course, whatever the principal and interest that are paid, they are guaranteed. They are guaranteed by the originator, by the they are guaranteed by the originator, which means they are not based on the performance of the underlying mortgages, not on performance of the underlying mortgages. They are guaranteedly paid. Means logically they are not true securitization kind of instruments, because in a true securitization we are talking about based on the performance of the pool, we see the cash flows, the principal and the interest are paid to the investors. So, and even this particular entity is not bankruptcy remote also. In general, when in a typical securitization transaction, we talk about the entity which is issuing these kind of bonds is generally high rated bankruptcy remote kind of an entity. So covered bonds have these kind of features, which is just a cover against a pool of mortgages, or probably a pool of mortgages act as a cover for the bond that are issued, and they are purely denoted on the balance sheet itself. Whereas on the other hand, we talk about another set of structured products called mortgage pass-through securities. This is probably a true securitization kind of transaction. The reason being, okay, all the loans, right? All the loans or home loans specifically, they are pooled, right? And they are sold to a third party entity. This third party entity, called as a special purpose vehicle, generally is bankruptcy remote, and this will issue the securities to the investor, and the cash flows from this underlying loan, the principal and the interest that come from this underlying loan, will be paid as principal and interest to these investors. So what is happening here is, when the loans are sold off to this third party, the third party is funding the cash here directly. So which means these loans are directly taken out of the balance sheet of this particular entity. So they are becoming pure off balance sheet transaction, and the payments here to these investors, they are purely based on the cash flows that are generated by the pool. And what we also see is, these instruments are called as mortgage pass-through securities. They have some kind of government backup to a large extent. When we say agency based mortgage pass-through securities, they have a government guarantee or a government backup associated with them, which means almost to a large extent you see they are bankruptcy remote, so the default risk chances are much lesser. But the major risk in this entire process is the prepayment risk. When the homeowners typically pay off their principal very early, even the investors also receive the principal very early. And generally it is observed that the principal is repaid early when the interest rates have fallen drastically. The reason is, the borrowers, they want to they want to refinance their loan at lesser interest rate. So obviously, whatever the principal that this investors are receiving, they may not be able to reinvest them at a better interest rate, thus losing out. So that is one of the key risks that is associated with respect to this mortgage pass-through security. Right? Now, the other set of important products which are a slight improvement over the mortgage pass-through securities are the collateralized mortgage obligations, typically called as CMOs, collateralized mortgage obligations, more or less same as your typical mortgage pass-through securities or mortgage-backed securities. Loans sold off to a third party. The third party purchases the loans, pays the cash, and issues securities. If it issues the securities in a general form where the cash flows from this are flowing into this, that's a typical regular mortgage pass-through security. But if the securities are created into multiple groups, right, instead of one, if this entire cash flow or if this entire set of investors, probably I group into two or three categories. So it's like I have created three products instead of one product. Instead of one kind of a bond, I have created three or four or five kind of bonds, wherein the risk and return characteristics of each of these groups is completely different. Means the cash flows of each of the group are structured based on some predetermined conditions, rather than saying the cash flows whatever come from here are paid to these parties uniformly across. Rather than that, they are grouped based on something. Okay, this could be a 5-year maturity bond, this could be a 10-year maturity bond, and this could be a 20-year maturity bond. So either the grouping could be based on the maturity structure, or it could be based purely on the interest rates that are being paid, the coupon rates. This could be a fixed interest rate bond instrument. This could be a floating instrument, floating rate bond instrument. Or sometimes the categorization could be on credit risk. So whatever may be the payments that are coming from here, this bond will receive a fixed payment. Even if we get more from here or less from here, this set will be paid the same amount. Any excess or deficit will be taken by this group. So based on the credit risk also, this grouping can very well happen. So the instruments which are created purely based on multiple groups or otherwise called as tranches. So the multiple tranches based on the cash flows, that is what we call as collateralized mortgage obligation. Now, in a collateralized mortgage obligation, there could be different kinds of structures with respect to payment. Generally, we talk about a waterfall structure, or sometimes people use a sequential pay kind of a structure, wherein they say, okay, the cash flows we are structuring in such a way that, okay, this group will receive the interest as well as the principal first, whereas this group will receive only the interest. Only after this group finishes receiving all the principal and they are completely paid off, then this group will start receiving the principal portion. Otherwise, until that time, this group will receive only the interest portion of whatever the payments that are coming up. So like that, the waterfall tranche or a waterfall kind of a structure or a sequential payoff structure can very well be created, and which means different maturity period. This set will get all the principal paid off within no time. Means their maturity period is much smaller compared to this group when compared to this group. So that could be a kind of payment structure that could be there. Or if there are any products that are created based on credit risk, it may so happen, okay, if there are so many defaults that are occurring here, probably this group will absorb all those defaults, otherwise called as equity tranche. Probably based on the credit risk, if the classification is happening, this group can be called as a senior tranche. This group can be called as a subordinated tranche. And this could be an equity tranche itself. So it can so happen that the classification can come like this, which means any kind of default or loss occurring on the loan products, the equity tranche will bear the maximum portion of the risk, then it goes to the subordinated tranche, and then it goes to the senior, which means the senior tranche generally is having a high credit rating and very less probability of default, right? So that is one more kind of instrument that could be there. And okay, when these are housing loans, we called these kind of instruments as collateralized mortgage obligation. But these could be anything else. These could be, let's say, any other debt obligation, any other debt, corporate debts or any other debts if they are there, the same instruments that are getting created, we call them as collateralized debt obligation. Or let's say if these are other loans, student loans or any such kind of loans, vehicle loans, student loans, then we call them as collateralized loan obligation. So the fundamental principle is still the same. Depending on what are the assets in the underlying pool, we call them based on those terms. Or sometimes it could even go to the extent, or even if this is mortgages, we call them as mortgage backed securities without this kind of a pool. But if there are any other assets, let's say credit card receivables or vehicle loans or student loans or any other kind of thing, we call all those securities under a general group called asset backed securities. Some credit based asset is backing the securities, so that's where we call them as asset backed securities. Mortgage backed securities is one specific form of asset backed security where the underlying pool is purely the mortgages itself. And just like these, even today we have seen the instruments like CDO squared, means a CDO of a CDO. So here the pool is CDOs itself or CMOs itself, and another instrument is created here. So CDO of a CDO, which is otherwise called as a CDO squared kind of a mechanism also. And what we could see as just a summarization, whenever I talk about any structured product, the first difference could be the pool. Some of them may have some loans, specific loans. Some of them can have some bonds, or there could be credit card receivables. So any of them, different kinds of loans. So the pool is one differentiator. And we are talking about the size of the tranche and the number of tranches. That is the differentiator. How many tranches are there and on what basis the tranche is created? Is it based on the maturity? Is it based on credit risk? On what basis the tranche is created? Then we are talking about active versus passive management of the of the pool. See, when we talk about a typical loan kind of instruments, home loans or vehicle loans or something, they they are typically they pay themselves down. Like at the end of 20 years, the home loan will not be outstanding at all. Or vehicle loan, if you have taken it for 5 years, at the end of 5 years, the loan value will become zero. So they are like, even if the instrument is created using those loans as the backup, at the end of the time period, the loan is closed. So even the structured product is closed. So they are like passively managed. But in some cases, what you see is the pool gets actively managed. Means some loans, once they are expired, once they are over matured, some other loans get into the pool. So the pool is like a never ending kind of a pool, or the pool's expiry date does not match with the underlying assets maturity date. The pool can mature even at a later date or much at an earlier date, because we are talking about adding assets to the pool or selling off the assets from the pool. So the pool gets more and more actively managed, especially like a credit card receivables. The moment within no time the credit card payment happens, and if the pool is completely paid off, and if the underlying assets are also closed down, then it may be very difficult, because the payment time periods are much lesser. So in those cases, it may so happen that the existing elements, existing pool composition is closed and new composition is added, and whatever the payments are there, they are utilized to purchase new assets into the pool. So so the actively managed pool, we have to differentiate. So we have to understand whether the pool is actively managed or passively managed. Generally, anything associated with long-term loans like home loan, mortgages, or vehicle loans kind of thing, they generally are passively managed. But when we are talking about short-term scenarios like student loans, or even credit card receivables kind of stuff, we see that they are actively managed itself. And so like this, what we see is various structured products do exist. Their risk and return, in terms of risk and return, they differ drastically. So this new innovative world of securitization and creating structured products is occupying a bigger market share today. So understanding these things to a large extent will definitely help in making progress in the financial world. So then now we would now once we understand the various structured products, I would try to look out for the capitalization structure, capital structure that is present in the securitization process, right? So as a part of understanding the capital structure, we all have already discussed to some extent in this structured products scenario. We always, especially if it is created based on credit risk, we see a senior tranche, we see a subordinated tranche, the set of investors. We get into these three, at least at a very broader level, there is an equity tranche. Whatever the pool of cash flows that are there, pool of mortgages or whatever they are, when they are sold to this third party entity, the special purpose vehicle generally creates three major tranches, especially if the tranching is done based on credit risk. If the tranching is done based on maturity or any other thing, probably a waterfall kind of a structure or a sequential pay kind of a structure can very well crop up. But when we are talking about a typical credit risk perspective, what we see is we see a senior tranche, which is priority wise, they have the highest priority in receiving the principal as well as the interest, and because they have very low amount of risk, even the return is much lesser, means coupon is much lesser with respect to this group of securities. Whereas when we talk about this, they do not receive any fixed principal or interest. No fixed principal or interest. They only receive the residual after the payment to this group of investors is done. After the payment to this group is done, whatever is left will come to this group. Mean, let's assume that in this particular month, these guys have paid some amount of EMI. All these borrowers have paid some amount of EMI. Out of that EMI, there is some interest portion, there is some principal portion. The principal portion and the interest portion corresponding to this particular bond investors would be paid first, then to this, and whatever is left out of this cash flow after paying to this group as well as this group, whatever is left will be paid to this particular group. That's the reason we call them as the equity tranche. And they may receive more, they may receive less also. They may receive more than what these set have got, or they may receive less than what this set have got. So whatever they are receiving is completely variable, and even the size wise, this, I mean, the number of bonds or the face value out or proportion of this cash flows, this is a large composition, whereas the size of this is quite smaller. Probably if this forms 60% of the total cash flows, this could form only 10% of the total cash flow. And this subordinated, or sometimes people call it as a junior tranche, or sometimes it is called as a mezzanine tranche, because it is acting as a bridge between the equity tranche and a senior tranche. So from that dimension, it's even called as a mezzanine tranche. And generally we see, okay, because the risk levels are slightly higher than the senior debt but lower than the equity, so it is somewhere in middle. So even from this standpoint, the coupon is slightly relatively higher compared to a senior debt, even if it is a floating kind of a payment instead of a fixed coupon, then the spread is also higher compared to this group. Even from a volume standpoint, this also will be slightly on the lower side itself. Probably this could be around 30%. If this forms 60, this might be 30, and this might be 10% itself. So that is one way to look at the capital structure dimension. And at the same time, when we are talking about this entire credit risk management episode, what we are able to see is this group is completely protected from any kind of defaults. These are the next level of risk, whereas these are taking the highest risk in the process. So it's basically that the risk is shifting from this group to this group, or probably from this group to this group. So so from that dimension, we also need to look out for what are the credit enhancements that are there to make sure that the ratings are much better. We are talking about the credit enhancements in this process. In some cases, I mean, to make sure that these guys are fully protected, see, 60% of the cash flows, 60% of this is going into the senior tranche. What if 50% of the people default? So the entire 60% may not be paid. Means this is becoming risky. It's not becoming completely risk free. So from that dimension, to make sure that at least all 60% of the people will receive, there are some credit enhancements that are expected. Sometimes they are purely external in nature. When I talk about external credit enhancement, it's as good as I'm taking an insurance policy or purchasing some kind of derivative instruments in the outside market, which will shield whatever may be the default from this side. It ensures the payments to this group of investors. So those are called as my external credit enhancement. Or there could be two major forms of internal credit enhancement, which can be classified as hard as well as soft. What do they mean? In terms of internal credit enhancement, we are talking about over collateralization. Means if if the loans are worth 105 million, probably the face value of all these bonds issued is only 100 million. Means even if 5 million is getting defaulted, still no loss occurs to these groups. Right, so if the face value of this is 105 million, I'll try to I'll try to issue bonds only to the worth of 100 million, so that that 5 million, even if some default occurs, I'm better off, or my investors are better off. So because that difference is known in advance, at the time of initiation itself, the difference is clearly known. The protection is available at the beginning of the pool itself. We call it as hard credit enhancement. Whereas on the other side, we talk about excess spread, which is the protection that comes because of the difference between the cash inflows that are coming from the collaterals, from the loans in the form of interest and principal payments, and the cash outflows, the interest and the principal that need to be paid to all these groups. Whatever is the difference, cash inflows and cash outflows, the difference is what is contributing to this excess spread, and that spread is invested to get a protection against the future shortfalls that are going to come up. So the protection comes over a period of time and not at the beginning, and that is where we call this kind of this kind of enhancement as a soft credit enhancement mechanism, right? So from a credit structure, capital structure dimension, we are talking about the proportions of the face values of each of the tranches, and what kind of credit enhancements can come up as a part of this protection process. All right. So next, what we will look at is how do we understand this waterfall structure through a typical numerical example. Now, when I talk about the waterfall structure, we have been talking about a typical set of process, right? It's a process which governs how the cash flows are to be paid, how the cash flows are to be paid to different tranches. So who will receive the principal part, how much principal will be received by each of the tranches, how would the interest payments be made, all these things, and how would the equity tranche be paid, how much will be distributed, let's say from the residual, from the excess, after paying off to the senior tranche and the subordinated tranche, how would the residual be distributed among the equity tranche as well as the trust which can invest the excess spread. How would I identify how much has to go into each one of them? All these are identified as a process in the waterfall structure. right? And even the over collateralization trigger, which is how the residual gets built up, how much is distributed here versus here, because the more and the more the pool gets into the trust based on this excess spread, it acts as a very strong reserve for any kind of future losses that can come up. So generally, what the assumption that these payments go with is, they initially assume some constant default rate, let's say 1%. They assume some kind of constant default rate in the beginning, and based on that, they try allocating to the senior tranche, the subordinated tranche, and then to the equity tranche, and the remaining to the trust. Now, if the defaults in reality are much lesser than what has been estimated by this constant default rate, then obviously the proceeds are much higher, and probably the equity tranche can get quite a good benefit out of the same. Let me take a simple example for us to understand the whole process. Let's say the total loan amount, right? The total loan amount, let me assume that it is $100 million. This $100 million loan is securitized, and let me assume that the payment, right? Probably, let's say these are all floating rate loans. So the interest rate on this floating rate loan, probably let me say LIBOR plus 2%. Now, on the other side, using this loan as a collateral, let's say some structured products have been created. Probably there is a senior tranche which constitutes, let's say, 75% of the pool. So $75 million, and let me assume right now I'm not going for any kind of over collateralization to start with. So let's say the senior tranche is 75 million, and I've created a subordinated tranche which is let's say for 20 million, and the equity tranche is, let's say, 5 million. So let's say this is how the cash flows of this are mapped to this. And because this is a senior tranche, let me assume that the payment is only LIBOR, because the rate can be much lesser because the risk levels are much lesser here. So I am assuming that the senior tranche will get only LIBOR, whereas the subordinated tranche should get slightly higher. So I'll say LIBOR plus let's say 4%, and the equity tranche will get the residual part of it. But on that residual also, as we said, there is a distribution between the equity tranche and even to the trust. So for that, what we say is, okay, the equity tranche at the max, at any point, they will receive to the extent of, how much should I say, uh, how much are we going to get in this LIBOR? So this, if I'm assuming 8, right, overall 8 million. So probably let me put it to the extent of, okay, 150,000. 8 million, 5 million is this. So 5% of 8 million. Forty. So these guys are going to get 40,000. So probably, yeah. if I put a cap, let's say around 100,000, anything anything that exceeds 100,000 in the residual will be going into the trust, and the equity tranche can get at any point a maximum of 100,000. This 100,000 is what we call as the over collateralization trigger. Means out of the residual, to a maximum of 100,000 is allotted to the equity tranche, and any excess residual above this 100,000, it is transferred to the trust. Now we can think about now the next step. Let's assume right now the LIBOR is somewhere around 5%, right? And the default rate for the time being, I'll assume it as 0%. I'll take two cases. For the time being, I'll assume that the default rate is 0%. Now, how much proceeds will come from this 100 million? So, if I'm looking at the cash inflow, which is coming from the loans only in the form of the interest portion, 7% is the interest on 100 million. So, 7 million is the typical cash inflow at this point from this loan. Okay, now what are the face values of these bonds? 75 million is the senior tranche. So on the senior tranche there is a 5% interest that is getting paid. So the cash outflows wise, if I am seeing the senior tranche will receive 75 into 5, which is almost 3.75 million is going to the senior tranche. Now, if I am talking about the subordinate tranche, their face value is 20 million and they are going to receive 9%, right? So almost 1.8 million is going to the subordinate tranche. So probably here let me call 1 million. The equity tranche will receive to an extent of 1 million and the remaining will go to the trust. So once these two parties are paid off, the residual is what is going to the equity tranche. So I am putting that cap as 1 million. So what is the residual? It's already 3.75 plus 1.8. 5.55 million is already being utilized, means only 1.45 million is the residual. If 1.45 million is the residual and there is a 1 million cap for the equity, so what I can do is 1 million will go to the equity tranche to the maximum, because the residual actually has to go to the equity tranche, but at the same time it has to go to the trust also. The remaining 0.45 million will go into the trust. That is the way the typical allocation happens. But assume that instead of 0% default, the same example, if I am saying that the default rate is going to be 5%. Now, whatever the cash inflows that I am getting, it will not be entire 7 million. I will, or probably if I am assuming that the default rate is 10%. So I will be receiving only 6.3 million. I may not receive all the entire 7 million here. I will be receiving only 6.3 million. Means the residual for me in this case will be only 6.3 minus 5.55. So which could be only to the extent of 0.75 million. And because of this 0.75 million is lesser than the equity cap of 1 million. So at least the payment will happen to the senior tranche as well as the subordinated tranche without any problem. But the equity tranche this time will receive only to the extent of 0.75 million and nothing will go to the trust. Whereas on the other side, if the default had been 20% instead of 10%, probably what is received is only 5.75 6 million, or probably if I say the default is 25%, what is received is only some 5 odd million. So in that case, what happens? This party will still receive its 3.75 million, but this party cannot receive the entire 1.8 million. So probably they may receive only around 1.3 million. Means the subordinated tranche also will start absorbing the loss if the default rate goes to this extent of 25. And of course, the residual tranche, which is the equity, and the residual is directly zero, which means the equity tranche is going to receive zero and no contribution happens to the trust. So this is the typical way we can take the example of a waterfall model and distribution of the cash flows to the various tranches based on the expected default rate, and how each of the tranche absorbs the overall losses in the process, right? So once you understand this particular numerical case, solving any kind of or understanding where which tranche will enter into the loss, at what level each tranche will enter into losses, will start accumulating the losses, and all these things can very comfortably be understood, right? Now, if we look at the typical participants, right, I would like to look out for the various participants in the securitization process or in the creation of a structured product, right from originator, who is the typical entity which has issued the loans. It could be a bank or any kind of lender. So they are acting as the originators in this securitization process, and we have underwriter who are typically purchasing these loans, and based on that they are trying to come out with the features of the mortgage backed securities or CMOs or CDOs, whatever are the structured products. They get into assessing the underlying loans or credit claims, and based on that coming up with the issue of the structured products. So these are the participants who actually do the structuring process. So there could be a structuring agent also, whom they would be hiring as a specialist to actually structure this particular deal, where the focus is on identifying the size of the tranches, right? How much will go to the senior, how much to the subordinate, how much to equity, and how much to, so those kind of tranche identification. Then what should be the coupons, what should be the credit ratings associated with each one of them, and this party would be responsible for issuing these instruments to the investors. So if the issue is not subscribed, or if it is not fully subscribed, or if the value of this underlying loans which are acting as a collateral, if their value falls, means if more proportion of people start defaulting, the risk is fully borne by the underwriter. So underwriter is a major role in this structuring process. Then we are also talking about an important role being performed by a servicer of the loan. The servicer of the loan is the entity who is responsible for collecting principal and the interest from the borrowers. So if there is any delay, the servicer is responsible even to provide liquidity in case of any kind of a delay. So the more and more risky in terms of collection, probably the servicer's fee is going to be much higher. So it's one more role that comes into picture. and so there the conflict of interest can very well come up. So just to get higher fees and all, the servicer can get into the delaying of the collection processes, or to avoid the risk, he would try to collect only those from those kind of customers where the collectability is going to be much easier, not much of delays, so that he does not need to arrange for the funds to provide the liquidity of the system. Similarly, we are talking about another major entity in this process called the rating agencies, who are actually responsible to rate the various tranches. They provide the rating to the various tranches, which would actually help the investors to take their decisions quite comfortably, because they are typically the third parties. They do not belong to the underwriter or the originator, so they are the third parties, and they play an influential role in how much of what is the size, what should be the size of each of the branches, by and based on that assigning the appropriate credit ratings. And if required to get a better rating, they would suggest possible credit enhancements also, if and only if this particular credit enhancement, either in the form of external insurance or internal over collateralizations or excess spread kind of arrangements are there, the rating agencies may not be interested to increase the credit rating of these various issues. But here where the conflict is, the rating agencies want to grow their business, but the more they have to see if they are giving more weightage to equity tranche or something, and if there is a lot of default occurring, probably the rating agencies are actually selling their reputation. If they have to grow, typically when they are charging anything, it is like they are selling their reputation, and anywhere the reality does not match the ratings issued by these agencies, it will have a strong impact on the growth of their business. In some cases, the investor themselves may try to protect against this kind of risk by taking some insurance policies or something of that sort. And we also have a fund manager, or what you call especially if it is an active pool. The portfolio manager also is one more role that comes into picture, which loans should be added, which should be subtracted, so that the risk is almost minimized. So such kind of participant also plays a role in the securitization process. Apart from that, there is a lot of administration related activity taken care of by the custodians and trustees. There are so many other people who are playing major roles in the securities securitization market in the creation of structured products. For these people, the role is more in terms of document verifications, right? They typically will be responsible for distributing the funds, distributing or transfer of funds between the various entities. These are the typical roles that are taken care by these custodians and trustees. So like this, you find in the typical securitization market, in the creation of the structured products, we see lot number of participants actively participating in this larger market, right? Now, in general, we would like to go a little bit deeper into what we call as three-tier securitization structure. That's a common structure which we have been discussing till now. But typically, I would like to coin a name for. I like to come up with a name for it, which has been used very popularly as three-tier securitization structure. Basically, it's like three tranches are generally created. For one is a senior tranche, then we have a mezzanine tranche, and finally an equity tranche. So wherever such a kind of a structure is created, we call it as a three-tier structure. And typically when I look at the inflows into this kind of structured product, we are talking about the different kinds of cash inflows. One is the interest, let's say, on collaterals, which is the loans. Here I'll talk about intermediate as well as terminal. So in the intermediate periods, there is an interest that is coming on the collateral, and in case there are any default assets, so the recovery on the defaulted assets is also a kind of an inflow that comes into this securitization structure. And on the terminal stuff, whatever is the principal, right, the terminal cash inflows wise, I can see one, the principal portion of it, and two, whatever again defaulted assets and all are there during the last year, whatever is the recovery on the defaulted assets. And probably whatever are the intermediate investments, let's say there is a trust, the recovery on this default in the intermediate period, it is going into a trust, so there is probably the interest on invested amounts. So these are some of the things that are coming as inflows as a part of as a part of the structured product. But when I am looking at outflows, the same. Every intermediate period, there is a payout to the senior tranche, to the mezzanine tranche, and whatever is the residual, the residual would be distributed among the equity tranche and the trust. The residual is distributed among the equity tranche on the trust. Now, if the residual, which is generally calculated as whatever is the cash inflow minus whatever is the interest payment to the senior tranche minus the interest payment to the mezzanine tranche, whatever is there, that is what we are calling as a residual at the point T. Now, this is where the rules for the residual come up. If the residual, first, out of this residual, there is a comparison with the amount that is contributed to the trust. So let's say I am talking about the amount that would be contributed to this trust. So if I say the residual is greater than the amount that is contributed to the trust, then the trust, so this year a K would be contributed to the trust, and the remaining, out of that residual after taking out K, that would go to the equity investors. That is in the intermediate cash flows. But assume that the RT is positive, the residual is positive but it is less than K. Then whatever is the residual that is there, that would go to the trust, and equity holder will not get anything in that. And the other possibility is the residual typically might be negative itself. Means it is not sufficient to cover the payment that are to be made to a senior tranche as well as the mezzanine tranche. So typically the difference which is nothing but what is the interest payment to the senior tranche, interest payment to the mezzanine tranche minus whatever the cash inflow that has come, that is what we call as the shortfall. So now we are going to check whether this shortfall, whatever was the amount which is shortfall, is it less than the amount that is present in the trust value. How will I get the trust value? What are the amounts that are going into the trust? Every year, this K, which is your over collateralized value, this K is going into the trust and it is earning interest. As long as your RT is greater than K, the K is going into the trust and it is earning interest. And at the same time, if at all there are any defaults that have occurred, the recovery 30%, 50%, whatever is the recovery that happens on those defaults, even that amount is going into the trust and it is accumulating value year over year. So in any year when there is a shortfall by this extent, it is compared against the value that is already present in the trust. If the shortfall value is less than the trust value, then the amount will be pulled out from the trust and be covering the shortfall, means there is no default to this as well as to this, and the trust value will go down to the extent of the removal, reducing by the extent of the shortfall. But in some cases, if the shortfall is much greater than the trust value, that is where you see that the loss gets absorbed by the mezzanine tranche to that particular extent. Only from that point in time, the mezzanine tranche will start accumulate or will start getting into the losses. But otherwise, the losses are adjusted in any one single year. If there is a shortfall, it would be adjusted from the accumulated value that comes from the trust itself. So that goes as a part of the intermediate payment. But look at the terminal. In the terminal, there is probably, I need to look at the terminal cash outflow slightly differently, because one, the principal has to be refunded, not just the interest now. The principal refunding has to happen, and there is no diverting to the trust. Whatever is left, that goes to the equity. So, though there is no point in checking the trust or even checking for over collateralization, checking out for the residual and comparing the residual with the K value. There is nothing required for the terminal. Everything else is going to the equity investor itself. So that's the reason we are looking at the intermediate cash flows and the terminal cash flows in this case quite differently to address this case. So let just for an example, let me take, okay, let's assume that initially I'm talking about 100 loans, right? The original pool, 100 loans, $1 million each. So overall, the underlying pool value was 100 million. And let me assume that on this collateral pool, I was getting a 5% rate of interest. Now, based on this, let's say we have created a senior tranche. Based on this, we have created a senior tranche, let's say for 70 million, and we have created a mezzanine tranche for 25 million and an equity tranche for the remaining 5 million. Alright, and on the senior tranche, let's say I am paying 3% interest. On mezzanine tranche, let's say I am paying 8% interest. Now, let's assume that in this final year, now we are in the final year. By this time, only, let's say, 92 loans are surviving, or 90 loans are surviving, means 10 have already defaulted in the earlier years. So in this year only 90 are, by the beginning of this year 90 loans are surviving, and probably 2 defaults in the final year. 2 defaults which have given rise to, let's say, 50% recovery in each one of them. 50% recovery means 500,000 is recovered in each of these cases. And whatever has been the trust till date, the trust has accumulated till date, let's say the trust has accumulated $10 million, either through regular investments, or there are 10 loans that have already defaulted, so the recoveries from those, or whatever it is, overall, let's say by now the trust value has accumulated to 10 million. And every year, let's say the trust is able to generate again a 3% interest. Every year the trust is able to generate a 3% interest. Now if I want to look at how much the equity tranche will get in the final year, to look at it in simple terms, okay, this year how much is the cash inflow? So when I look at the cash inflow, okay, one, the interest on the loans as well as the principal, because this is the final year. The interest, there are 90 loans, so 90 million with an interest of 5%. So 90 million with an interest of 5%, probably I'll call it as 4.5 million is in the form of interest. 90 million is in the form of a principal, so 94.5 million. And at the same time, this period, okay, if I am talking about probably, let me say 92 at the beginning of the period, out of which 2 are default. So 92 at the beginning of the period, and 2 of them have defaulted during this period. So for those 2, I am going to recover only 50% of them. So 1 more million is coming up as a recovery for those 2, and finally coming up to 95.5 million. And at the same time, now there is no more question of trust. So the trust is having 10 million, which will again generate a 3% interest. So 3% interest is around 0.3 million. So overall, even the trust is accumulating to 10.3 million. So if I look at it at the end of the year, by the time the maturity is approaching, your total cash inflows are to the extent of 105.8 million in the final year. Now, when I talk about the payment to each of the tranches, I know now 70 million has to be paid to a senior tranche. 70 million needs to be paid to the senior tranche. So I'll be paying out of this 105.8, let's say I'm paying 70 million to them, and mezzanine tranche another 25. So overall 95 million is already being paid out. So what I'm left with is just 10.8, and at the same time to the senior tranche even the interest has to be paid. So 70 million is the principal plus 2.1 million is the interest. So 72.1 needs to be paid to the senior tranche, 25 million and around 2 million, 27 million. So 99.1 million has to be paid to the senior as well as the mezzanine. So there is no default on these 2. Without any kind of impairment, the payment can happen to these 2. But what is suffering is the equity tranche, because you are paying only 6.1 million, whatever is left. that is going to the equity tranche. So depending on how much is going to be recovered and what is the total value of the investment at each of the periods, all that is getting contributed, right? And if the if suppose, let's say, the trust did not build up this much of reserves, then obviously it is going to result in a loss, and probably the equity tranche might not receive anything out of it also. So that is how the typical allocations happen in the intermediate years as well as in the final years. So a typical numerical calculation will bring out a comfort in terms of understanding how the allocations across the various tranches typically result in as a part of this securitization process, right? This method is more and more appropriate when the assumptions are pretty simple. For example, the default rate we are treating as constant every period. The every loan, the probability of default across all the loans is the same, or even the default rate is same or constant across the years, or we have ignored the correlation between the various loans. In all these scenarios, the assumptions become more and more simple. So the earlier mechanism works quite comfortably for us to compute the how much would each of the tranches get, and where will the losses start getting absorbed by the various participants, etc. But if there is a lot of complexity and all these things can change over time, can change over the life cycle of the loan, then, and if the loan's composition is quite drastically different with respect to their various characteristics, then a better way to perform this entire process is the simulation itself, wherein I will get into the estimation. There are three key steps we talk about. One is the parameter estimation. When I say parameter estimation, it goes right from identify all the critical parameters, including, okay, what is the rate of default, what is the hazard rate, default intensity, or probably what is the correlation that is present between each of the loans. So getting all this, though obviously is a very difficult thing, because not too much of market related data will be available for each of these aspects, but probably we can look out for either a Coppola based correlation analysis, which can be theoretically accomplished, or some kind of sensitivity related analysis need to be performed for arriving at various estimates regarding the same. But whatever is the mechanism used to come out with the estimation of the parameters, then coming to identify if and when, whether this security is going to default, and if it is going to default, by what time it is going to default. So the simulation should help us in arriving at those kind of values, and in case it is defaulting, what is the amount of the losses, what is the chance that the loss, what are the various losses, what is the distribution of these losses, what is the probability that the loss crosses something, in what time what loss is going to occur. So a kind of a loss distribution will come up, from where appropriate analysis will try to bring out the value at risk associated with these kind of for each kind of a tranche in the securitization process. Based on the tail assessment of the distribution, we can try to arrive at the value at risk associated with each of the tranches itself. Now, another comparison that we are going to primarily look at is, we will look at two important parameters. One is the probability of default. If it increases or decreases, what could be the impact on the senior tranche, the mezzanine tranche, and the equity tranche? Value as well as the credit value at risk. Similarly, I would like to look at the other dimension, which is correlation between the various loan portfolios, or correlation between the underlying assets in the pool. If this is increased, again, what could be the impact on the value as well as on the credit VAR? This is what I am trying to understand now. Straightforward, the first thing, let's say I am talking about the probability of default. If the probability of default is increased, right, the cash flows are going negative, because the cash inflows are actually coming down. Probability of default is increased means cash inflows are coming down, so the residuals will come down. So overall, the chances of default are increasing. The chances of default, if they are increasing, the value to all these tranches is actually coming down, because the actual cash flows are literally coming down. So the payments to each of these also will come down. So the risk is increasing, which will straightforwardly decrease the value of all the tranches in the same way. But the interesting aspect is with respect to this correlation. Let's say the correlation does not exist. We are talking about a correlation of zero between the various loan securities. Now, at least what is known is, okay, these are not related. So it means if this default occurs, we don't know whether this will default or this will not default. Same is the case with this. So at least there is, so if that is the case, in a large extent, what I can think of is, yes, there is no dependency between them. So the expected number of defaults, whatever we have computed, there is a good chance that the actual defaults will come very closer to this expected itself, because there is a real independence between them. It's not that none of the loans will default. It's only that there is no dependency. It doesn't mean that. It means that if the loan 1 defaults, there is no need for loan 2 to default. But overall, it might create an opinion that the actual number of defaults will be very much closer to the expected itself. And because of that, because the expected default rate has already been incorporated as a part of the original valuation process, we don't see that the senior tranche will be impacted at all. Probably the equity tranche, if we look at everything is as per the expectation. So what we could see is the senior tranche might not be impacted that much. The value of the senior tranche might not come down. So probably even but on the other side, if I see, if the correlation is increased, means probably 0.5 or something like that, then it means if this defaults, there is a good chance that even this will default. So overall, the number of default can go much higher. Or on the other side, if this doesn't default, there is a chance that this also does not default. So overall number of defaults can either go too high or even too low. Means it's very difficult to predict the actual number of defaults because of too much of correlation existing between them. So if the correlation is increasing, what I could see is the value of the senior tranche is going to come down. If the correlation is increasing, the value of the senior tranche is going to come down, whereas on the other side, the value of the equity tranche is going to go up. Why? When we are talking about the equity tranche, there is a possibility if the correlations, see, when the correlation was zero, it is very much known that on an average these many defaults will happen, right? So it is very much assured that the equity tranche will go into some kind of write-offs. But if the correlation is high, it might so happen that none of them may default. There could be some possibility where none of them may default, and that too, if especially if I know that if this is not defaulting, the others may not default. So there could be some kind of scenarios where overall the default may not occur, which means the value of the equity tranche will typically go up. So in a way, when I am talking about the mezzanine, if the correlations are very close to zero, the mezzanine tranche also will decrease in value. If the correlations are very close to 1, the mezzanine tranche will have an increase in the value. But because the volatility is increasing very heavily because of this, means either more defaults could be there or less defaults could be there. Because of that much of volatility, when we talk about the credit VAR, value at risk, we talk about the in all the cases, the credit VAR is going to increase itself. And this is where probably the value, because the value is actually decreasing but on a constant note, no volatility that is associated here. We know that the whatever if the probability of default is increasing across the board, all the values are decreasing, and because there is no variation or volatility, we see that the credit VAR also comes down for here, but here the volatility is still existing, so the credit VAR is up. The same logic goes even here. Initially it is up and then it is down. So this is the kind of impact we see with respect to the probability of default, as well as the changing of the correlation. So just to summarize this, when you are increasing the probability of default, the value of all the tranches, it comes down unconditionally. But when it comes to the correlation, if you are trying to increase, each tranche is getting impacted differently. But overall, because the volatility parameter is going much higher, we see that the credit value at risk is going to be higher in this case. Because we are talking about the credit value at risk, especially for each of these tranches, and the based on the distribution of the losses, what could be this particular cutoff layer. So when you are increasing the probability of default, the VAR for all the tranches is the VAR for all the tranches is going to increase, but especially when I'm looking at when I'm increasing the probability of default, the credit VAR typically is going to increase for the equity tranche, and then it is going to decrease for the senior tranche as well as for the mezzanine tranche even. Now let's look at the mechanism of measuring the default sensitivities for each of the tranches. Now, just like the way we are talking about DV01 in case of a bond, spread 01 in case of spread, we are also talking about the same concept called default 01. It means that I am taking the current probability of default, and I am providing a shock to it. Like, okay, if the current probability of default is increased by 0.1%, which is nothing but 10 basis points. If the probability of default is increased by 0.1% or decreased by 0.1%, what is the impact on the value of the tranche? What is the impact on the value of the tranche? I am trying to take the value of the tranche if the probability of default is increased by 10 basis points as well as decreased by 10 basis points. I am trying to find out the value of each of the tranche and even the credit var, probably using a simulation kind of an approach. Now once I have arrived at those values, I am typically saying the default 01 is nothing but I am taking 1 by 20 because I am increasing it by 10 basis points. If you remember DV01, we have increased it by 1 basis point itself. That is why we used to call DV01 as price value of a basis point. Here we are not increasing the probability of default by 1 basis point, we are increasing it by 10 basis points, and that's the reason I am taking 1 by 20 times the mean value, and mean value I am trying to divide by the loss based on initial probability of default, and to this I am adding that 1 basis point, which is 0.1%, and again I am subtracting the mean value divided by the loss based on the original probability of default minus 0.1% or minus 10 basis point. Whatever is the difference that is coming up, that is what is adding up to my value of default 01. And what I typically notice in this case is the default 01 is generally positive only, which means the value will come down as the probability of default increases, which is what we have seen even from our previous expression also, that the probability, as the probability of default is increasing, the default 01 will keep increase because the value is actually coming down. Means as the probability of default is increasing, the speed at which the value comes down is going to be much higher. And at the same time, if the original default rates are much higher, assume that the original probability of default is much higher, what we could see is an increasing it by 0.1 or decreasing it by 0.1% hardly makes any kind of a difference. So that's where the default 01 may not be anywhere higher, will actually come down as the original default rates are much higher. At the original probability of default much higher, the default 01 will typically be much lower itself. And so these kind of various relationships, or probably there is a much more variation in the default 01. If the default 01, see, just like delta, right? Delta also, what we see is delta is coming down if the original rates of the original interest rates are much higher. Our duration is much lesser if the original interest rates are much higher. The same logic you can apply here also. And the volatility on this default 01 is going to be much higher, especially just like the concept of gamma, which is much higher at the money kind of an option, or probably the convexity much higher when the interest rates are very closer to the coupon rate. So that is the similar kind of a mechanism we are talking of. The variation in the default sensitivities will be very high when when the defaults are generating the losses which are very close to the attachment point, which is very close to that particular tranche's attachment point itself. So these are some of the kind of conclusions that you can very well draw from this measure of default 0, 1. All right.